The Vice President and I are very pleased to welcome you to our press conference. We will now report on the outcome of today's meeting. Based on its regular economic and monetary analysis, the Governing Council confirmed that the current ECB interest rates are appropriate. It therefore decided to leave them unchanged, taking into account all the new information and analysis which have become available since our meeting of the 4th of November 2010. We continue to expect price developments to remain moderate over the policy-relevant medium-term horizon. Recent economic data are consistent with the positive underlying momentum of the recovery, while uncertainty is elevated. Our monetary analysis confirms that inflationary pressures over the medium term remain contained. We expect price stability to be maintained over the medium term, thereby supporting the purchasing power of euro area households. Inflation expectations are firmly anchored in line with our aim of keeping inflation rates below, but close to 2% over the medium term. The firm anchoring of inflation expectations is of the essence. The Governing Council today also decided to continue conducting its main refinancing operations and the special term refinancing operations with maturity of one maintenance period as fixed rate tender procedures with full allotment for as long as necessary and at least until the end of the third maintenance period of 2011 on the 12th of April 2011. Furthermore, the Governing Council decided to conduct the 3 months longer-term refinancing operations, the LTROs, to be allotted on the 26th of January, 23rd of February, and 30th of March 2011 as fixed-rate tender procedures with full allotment. The rates in these 3 months operations will be fixed at the average rate of the MROs over the life of the respective LTRO. Overall, the current monetary policy stance remains accommodative. The stance, the provision of liquidity, and the allotment modes will be adjusted as appropriate, taking into account the fact that all the non-standard measures taken during the period of acute financial market tensions are, by construction, temporary in nature. Accordingly, the Governing Council will continue to monitor all developments over the period ahead very closely. Let me now explain our assessment in greater detail, starting with the economic analysis. Euro area real GDP grew by 0.4% on a quarterly basis in the third quarter of 2010, following exceptional growth of 1% in the second quarter. Recent statistical releases and survey-based evidence generally confirm that the positive underlying momentum of the economic recovery in the euro area remains in place. In line with previous expectations, this implies ongoing real GDP growth in the fourth quarter of this year. Euro area exports should further benefit from a continued recovery in the global economy. At the same time, private sector domestic demand should increasingly contribute to growth, supported by the accommodative monetary policy stance and the measures adopted to restore the functioning of the financial system. However, the recovery in activity is expected to be dampened by the process of balance sheet adjustment in various sectors. This assessment is also reflected in the December 2010 Eurosystem staff macroeconomic projections for the euro area, according to which annual real GDP growth will range between 1.6 and 1.8% in 10, between 0.7 and 2.1% in 11, and between 0.6% and 2.8% in 2012. Compared with the September 2010 ECB staff macroeconomic projections, the range for 2010 has narrowed somewhat and shifted towards the upper end of the September's range, while the range for 2011 is slightly narrower. The December 10 Eurosystem staff projections are broadly in line with forecasts by international organizations. In the Governing Council assessment, the risks to this economic outlook are tilted to the downside, with uncertainty remaining elevated. On the one hand, global trade may continue to grow more rapidly than expected, thereby supporting euro area exports. At the same time, it is to be noted that the level of business confidence in the euro area remains relatively high. On the other hand, downside risks relate to the tensions in some segments of the financial markets and their potential spillover to the euro area real economy. Further downside risks relate to renewed increases in oil and other commodity prices, protectionist pressures, and the possibility of a disorderly correction of global imbalances.